At every point in your trading life, you are going to come up with an edge. What works for you? Okay, so those of you who are interested in ICT, you can just visit this YouTube and then watch all the videos there. You will learn a lot. It's very insightful. I respect all the ideas. Great. So you have to come up with your own edge. Edge is what works for you, what you see that others do not see. Okay, after learning all the things, how do you put them all together to be your own strategy? That's the edge. Good. Should we go on? Are we good? Any questions from this first session?
Yes, please. Maybe we have not gotten there, but I read in the slide that you posted on the page, from the last page, you said any concept that you find and you want to use, you have to back test it.
Mhm.
So how do you do that?
Okay, good. So typically backtesting, the simplest way of backtesting is um, going to the using the history, what has happened before, okay, to checking that to see that the way you have learned as to how to come about for a buy or a sell, you check the history to see, okay, there are conditions or requirements, things that I want to see before I buy or sell. So if you check the history of price action, like what has happened already, what is the history? History is what is always on the left side of the chart. Okay, price is already printing. It is today, let's say it is today that you are starting to trade or learn how to trade. But people have been trading since 1990, 1980, 80. Like even people have been trading since last year. So there is the data, price movement, the action. Okay, so you have to go through those actions to see the strategy you are using now. How did that work for the previous years or months of price action? That is what we call backtesting. Okay. Then you have to now frame the same thing towards what is about to happen. And that's why you have to take those trades on demo accounts, not real money, so that you see if it's going to work out, you'll be successful or not. If you are successful, what make them successful? If you are not, what make them not to succeed? Then you keep refining and learning new things. That's the meaning of backtesting. So that is the simplest way out. But we will get more backtesting as we go on. Let's quickly go into the next section. If is there any other question from you guys? Any other question? Okay. How many people do we have now? Okay, that's enough. Um, so for this session, I want us to look at what I've called just a second. Okay, I want us to look at what I refer to as so if we've learned about the different types of movement or markets, like the intraday price action delivery. What happens, okay, um in a session or in price? Okay, so what is market structure? When we talk about structure, structure is the roadmap of price. The structure shows if the market is upward or downward or sideways. When we talk about structural shift, it is when price breaks a previous high or a previous low. That's when we say there is a shift in market structure or and we it's normally called break of structure. So we can have a BOS, break of structure to the upside, break of structure to the downside. Even within consolidation or sideways market, we can also see break of structure, or because we can also see internal highs and lows and structures being formed in consolidation. Um, so how many types of structural movement do we have? We have um, two types, two basic types. We have the impulsive move and we have the corrective. Okay. And when there is a shift or a break of structure, that normally could form what we call structural range or swing range. A structural range or swing range. So, how many types of structural movement do we see or have on the market? The basic one is two. One, impulsive, and then two, corrective. So, let me show you quickly what that means on the chart. So, let me take this clean chart here. So let's take, for instance, we are on this pair. Um, Good. Let's say we are here. So price, we are from up, we come down, go up, down, up, down, up. Then we get this. Then we get this. Then we get this. Then we get this. And then we get this. And then we get this. And then we get this. Good. Let's say we have this kind of situation. Good. So, at what point can we say there is a structural shift? And at what point can we determine or say that we have a swing range? At what point can we say that we have a structural shift? And at what point can we say we have a swing range? So, um, observe closely. What is the last? So, up to this point, from up here to down here, what type of market was that? Can you tell me what type of market was from up here to down here? Guys, can you please talk, respond? So this is a
Downtrend.
Downtrend.
what?
Downtrend.
Downtrend. Good. Thank you, Uchena. Downtrend or bearish market or bearish market. And what type of market is this? As it was going up here, I've already said it.
Upward trend.
This is upward trend, Eve. Thanks. Why is it a downtrend here and an upward trend? We've learned about the characteristics of upward and downward trend in the first session already, so I won't talk about that again here. But before price changed, so what do we call this area? When the downtrend ended and the uptrend came in, we call this area like reversal. Okay, because totally, and that is the last stage of the price movement cycle, because totally price has changed from going down to now going up. So this area is called reversal. Around this area, what happened? We will have to first see what we call break of structure or shift in structure. And sometimes we can also call it change of character. So the character or the behavior of price was down, but now it has changed character or behavior to up. So we have to see what validates that change of character. Normally, what you see is that, so the way that I look at that is, no matter the time frame you are using, always you need to be tracking that if you are on a downtrend at the last low, sorry, the last lower high that gave you the last obvious low. So you have to track this point to this point. This is the last lower high that gave you this lower low. The moment you see that last lower high is taken out by an impulsive move, okay, we can call this one, this at this point, as a change of character or a break of structure. They are not the same things, but we can use them interchangeably. So let's just say a shift or a break of structure. The moment you see a break of structure, the move from down here to the up here, that changed, that took a previous lower high out, okay, which gave the shift. This move is what we call the impulsive move. Impulse. Okay, the impulsive move. This one. Okay, so always you need the impulsive move must break structure. Okay, must take some kind of a previous high or previous low. We can flip this for a bearish market situation, but that is what is called the so when you see the impulsive move happen, what then can be will be the corrective move, the break of structure, the pullback, okay, the drop, okay. You see, it went up and took a previous high. The drop or the pullback or the retracement or the retest, this whole move is called this whole move is called corrective. Okay, it's called the what? Corrective.
Please, is it because the trend seem the same?
No, the corrective. So the concept is that, like I said, price does not move in a straight direction always. When it goes up, it will come down. But for you to know it is going to be go for an uptrend, normally the basic or normal thing is that we would have to see we would have to see high, lower highs, high, lower highs. But at this point, price was now creating the reversal pattern. Okay, so the issue is that we got a low here and we got a high that was an impulsive move that broke a previous lower high. If the drop were to, if the drop, the corrective were to take this low out, let's say price drop and took this low out, what would we have called that? Then it means that we are not making intentions of going bullish. We are continuing the downtrend. Are you getting my point?
Yes.
Because
So
we've
the
we've gotten
corrective doesn't mean the corrective is known by the sideways trend.
not really. It's not like corrective will give you a consolidation. Not really, but it's like a pullback. It's giving an opportunity. Okay, so let's say that's a different concept which I will teach. But let's say price is giving Okay, so we buy when price is low. When you go to the market, you ask that, oh, reduce the price, reduce the price. Okay, so now the market wants to go high, the asset wants to become expensive, but most times it will have to be come down so that people can participate, people can buy, give a fair or a low price. So normally that is the next concept I will teach, but we use what we call the Fibonacci to measure this range from where the impulsive move stopped, and we can track the pullback or the retreat, the corrective move, and we target below 50% always is below 50% is discount when you want to buy. It's giving you a discount price. At 50% is equilibrium, a fair price. And then above 50% is premium. We don't buy the mostly there. We buy, or the institutional or smart traders would take their buy entries at discount. They want a low price so that as price is going up high, they are making profit. Okay, so um, the concept will be new, but you understand when we get more into it. So it's not like the corrective will create that the consolidation. Yes, normally there will be consolidation or accumulation before the reversal happens. And the corrective and everything will happen inside the same range. So you are partly right. Okay. But the concept is that price has to give us, it has to give participants a fair price or a discount price to participate. Okay. So um, price drops, the most important thing is that we don't take this low out, because the moment we take it out, then the bearish market is now going to continue. Okay, so this low here becomes like our stop loss or our protection. Okay, that is what is protecting us from not going for continuing the bearish trend. But what I want to teach here for where we are in the lesson is that the impulsive move will break structure, will take a previous high when we are already bearish. It will take a previous high out. Once it does that, we should expect a corrective, which is a pullback. So the point where the correct impulsive move got to the from the point where it started to where it got to becomes our range, our swing range. And it is within this range that we are going to find buy entries. Okay, this becomes our range. This is where we will be looking for trade or setups. You get me? And within this range, when you measure on the Fibonacci, like I did earlier, you look for trades or buys below equilibrium, below 50%. Okay. So you want to ask, why is it that the corrective here is two? Price dropped here and then moved up again and dropped again and took this low out. Is this not still a bearish market? Okay, yes, it is. But that is where we have the concept of liquidity. Okay, this low was used as an edge, a compelling edge, like was used as a bait. Okay, was used as a bait for price to drop down to sweep and then it made the move up. So that is liquidity. Okay, so you will understand, we will get to make that more easier as time goes on. But what I'm trying to get you at is for us to see a structural movement, we have to see an impulsive move, corrective move, which is the pullback, and then that gives us a structural range or a swing range where we can frame our setup or our trade. And that's exactly what I'm showing right now. So this range, let me make this one red line. Within the two red lines, that's where you are using as your range. Okay. Why? Because there is a impulsive move that shifts or breaks structure. Okay. So when will you not be looking for buys? Only when price drops to take this low out. Then it means we can assume price wants to continue going down. And okay, and it with that, it means this whole bullish move from here up to here might not happen. Okay, so we have to, and how do you confirm that it will not continue to go down, but it's going to go reverse to go up? We use candlesticks, the formation. That is what we use to get the confirmations. So we will get into that. Okay. Um, what else do we have to look at? Any other question?
Please, you mentioned a term or like an instrument you use for the measuring,
Yeah, it's called
whether
the
it's
Fibonacci. Yeah,
Fibonacci,
yeah,
the mathematical term. Okay. Okay.
yeah, Fibonacci 2. Yeah, good. So we will get to it. Is part of the items we will be studying. Um, so the next thing is, what is liquidity? Liquidity is where orders are sitting in the market. So where the retailers or people put their stop losses, pending orders or cluster of trades. That's where um, smart traders might consider as areas of liquidity. Um, how many types of liquidity do we have? We have external range liquidity and internal liquidity. So, and we also have structural or inducement liquidity. Um, I will explain all this. This is a little bit complex to understand, but the most basic one that you can get is when you see any chart, all the high points and the low points that you see on the chart, just note those places as point of external liquidity, like here. This high point here, the highest point and the lowest point, like here. Note those places down as external liquidity point. That is the easiest one to identify. See, just take any chart on any time frame. Maybe let start with the higher time frame because that's what is going to give you a better view. Okay, or the highest point on the chart. You can view that as external liquidity point. Okay, so we will understand more with that. Um, Let me clear the chart once more time. Internal liquidity will be within. Okay, will be within. Structural and inducement, we will tackle that later. You will not really get it right now. Um, Perfect. So what is also still important for us? So let's look at support resistance. So support resistance zones are where price historically reacts because there are many orders there. Um, they are psychological zones where a lot of people finds as places where they will be confident to either buy or sell. So support level is where buyers step in. Resistance level is where sellers step in. So support is like the floor where you are stepping on or sitting on is your support, and the ceiling is like the top, the rooftop of your house. Okay, so when something hits it, it comes down, bounces down. So support and resistances will work mostly because there are pending orders and stop losses um, um, resting either below or above them, and price would have to go and reach out to them, and then so support resistance can be used in the flip side. Support can become resistance, and resistance can also be turned to support. When that happens, it becomes a very powerful area or zone. And that is where we are framing or have framed the precision or magic support concept from. The big picture. Market structure tells us the direction. Liquidity tells us where price is headed next, where price is going to go. Support resistance highlights where liquidity is hiding, right? Good. Um, so let's, with a few minutes left, I think we will need, if you guys are okay, we should do the one last session, and that one we can use Google Meet when the meeting ends, so that we can look at the live chart and map up or join together all the things we've learned. It's not compulsory, but if you have the time, you can stay for that when this meeting goes off. Um, so quickly with the 10 minutes left, let's see what we can make out of what we've discussed. Good. So, uh, okay. My God. Just a second. Okay, good. So let's go quickly to precision support resistance. So the concept of precision support resistance is simple. Um, so we know what support is. Support is where buyers will step into the market, and resistance is where sellers will step into the market. So what is then precision or magic about that? So let's say this is an Euro USD. Forget about forget about the lines. So let's go to 4 hour time frame on Euro USD. This is Euro USD. And this is on trading view. Okay. So this is the 4 hour time frame. Have you guys seen where I've put the blue line up here? This area.
Yes.
Let me make it very big. Good. So what did we say support is? Support is where buyers will step in, and resistance is where sellers will step in.
Stepping.
But let me address this. Before, when we started the class, I think Eve said she was seeing red and green lines. So these are the candles. The green normally represents bullish or bias, and then the red normally represents sellers. But you can change the color of the candles. You can make the green black, you can make the red black. But if it's going up, it is buys, bullish. If it's going down, it is bearish, sellers. Okay. But normally you will see green and red. So let's study quickly in the next 2 minutes. This is 4 hour chart on Euro USD. Let's study the characteristics around this blue line. So this is back testing. I want to go back to um, I'm going back to months or years. Afar, I'm going back very far. Even let me even go to weekly time frame. So this is weekly time frame. And that blue line is the big one that you see. Okay. So what do you see on that big blue line? This one here. What can you see from this weekly time frame? I believe a daily time frame will be best. One day. Good. What do you see? Good. So what I see is that exactly off the blue line. So and observe or check the body. You see, when you are looking at the candle, you can see the the candle has body. We will learn about characteristics of a candlestick, but we have the candle has lines up above them, which is called wicks or shadows, and we have body, the green, both the green and the red. Some have wicks above them or below them. Some have just bodies. Okay, the way you see them or the way they looks, okay, shows what they represent or what they mean. But we can see that on the blue line, anytime that the green candles are going up, let's say from down here to here, it gets here, it hits through the blue line and quickly rejects and leaves like a wick or line up and then closes below the blue line. And consistently for this candle up here, when it got up here, look at about how many candles. One, two, three, four, five, six. Okay, daily candles, like consistently for like a week. Okay, price kept hitting and dropping. What is the meaning? This place is acting as a ceiling, like the ceiling of your house, and pressing or pushing or crashing price down. So buyers wants to go up, want to take the price up, but the sellers are compressing or pressing the price down. This is what we call resistance. But you can notice that price exactly on the blue line drops. Okay, the blue line price drops, or there is always a body close below that blue line. We can see here that even price did not get to the blue line exactly. Okay, it gets close to it, but didn't, it gets rejected, okay, or resisted here too. And then later over the month, price come back to it again here. Exactly the same thing happened. Okay, then we keep moving forward. We keep moving forward. We keep moving forward from here. We keep moving forward. Just pay attention to the blue line. Okay, so we come here. Now, when you get here, finally, I've put a yellow line in between that. Finally, we were able to get a body close above the blue line. Okay. Then price, a body close above the blue line. Price comes down, goes up again, closes above the blue line, kept going up, comes down, kept going down. So you see, it's going up and coming to the blue line again, going up. But observe, on the blue line exactly price it buys. On the blue line, above it, it buys. Above the blue line, it buys. Above the blue line, it goes up. Okay. But when price drops and closes body below the blue line, it sells. See this sell, the red candles. Okay. Above goes below and is below the blue line, gets sells. Below goes above, but when it comes below, sells. Below, above, buys small, comes below, sell. Above, buys, drops below, little, sell. Goes up, uses the blue line as support to buy. So, what this is telling me is that in the past, the blue line was used as